Hi everybody, this is Osprey from MyChartCoach.com, and in this video we're going to take a look at the Russell 2000. We're going to look at SPY, take a little look at the S&P 500, the Dow Jones Industrial Average. We'll look at some of the inverse and the bull and bear ETFs, and yeah, we'll take a look at industrials, energy, and financials, and also tech. Okay, so technology sector. And so first up is a ticker symbol IWM. This is the Russell 2000, and so as you can see here, it has this descending resistance line going on, and then you have ascending support. Basically, it needs to hold this 50-day simple moving average, 100-day simple moving average. They're both at the same level, currently at right here at around 154, and then it also needs to stay above the middle Bollinger Band, which is the dotted purple line there at 154.35. It did close today above the middle Bollinger Band at EMAs 4, 8, and 13. For this to heat up, it's going to need to break above 155. If it can get above 155, this 160.50 is a really big resistance level. That's the descending zone to break. And then you have 157.50 is the next key level above. All right. If it drops down below this green descending resistance line, if it were to drop below 153, that would be a red flag, and you could see it pull back and test that 150 support zone. Okay, so let's look at TNA. This is the small cap bull 3 times, and so as you can see here, it has this symmetrical triangle pattern going on. It's either gonna break above this 100-day simple moving average at 71 resistance level. That's the gold line. As you can see, all these candles have been hitting that level and failing to break. Once there's a close above that, 73 will be the big level. That's the descending resistance line in this pattern, and then you have up here this 74 to 75 resistance zone. This high close from the 18th, that's going to be a huge level to get above. Now, if it were to drop below 68, that would be a big red flag. You could see the 200-day simple moving average down here at 65.79 retested. The action has been back and forth the last couple of weeks. Yeah, and it's trying to heat up here on the last 2 candles. You can see the lower wick yesterday bounced off this 200-day simple moving average support zone. But if it fails to get above this 50-day and 100-day simple moving average resistance zone, it could keep consolidating. The pattern has been very choppy lately for the big boards. And if you look here at TZA, this is the small cap bear 3 times. You can see it's closed today below the middle Bollinger Band. That's the dotted purple line here at 1121. It needs to get back above that level. The key level to break is the 50-day simple moving average at 1142. It came down here and bounced on the 18th, and it ran back up to this green line, the 50-day simple moving average, but it failed to break. It did get above the 100-day simple moving average yesterday intraday, but it pulled back. You can see how everybody's been getting shook out of trades. With all this action going back and forth the last few days, it's been really tough. And so the market's unclear right now on what direction it wants to head, and so it's going to be for TZA and the bears. It has to get above this 100-day simple moving average and turn into support. That's been the big level. It keeps on getting to that level and failing to hold and pulling back. Once it finally turns into support, the bears would win. Now, if this middle Bollinger Band at 1121 remains resistance and it drops below 11, that would be a red flag, and then you would see this 1050 support zone retested. So down here in this key support zone. And so yeah, so we'll keep an eye on TNA and TZA here and see what happens if they can break out, or if they if the small caps are going to head higher. The small caps have been have had a lot of plays, and so a lot of stocks in play with better uptrends than a lot of the big board stocks. So that's something to keep in mind. If you look at the S&P 500 here, it has this really choppy pattern as well. You can see it's been going back and forth. The chart is winding tight here. it has to hold this 263 support zone. If that fails to hold, the downside risk is it comes down and it tests the 200-day simple moving average at 259. That level was tested in February where they loaded heavy off of it, and then there was the big bounce off of that zone in April. And so far in May, it hasn't dipped all the way down to the 200-day simple moving average. Some people are thinking that needs to happen. We'll see. It has this, it's back below the middle Bollinger Band at 265.43. That's the dotted purple line. If that level remains resistant, you're going to see more consolidation, more downside risk. And so if it does break above the 50-day simple moving average at 267.61, that would be your signal that it's really heating up. That's the descending resistance line here. And then, back up here at this 269 to 271 level, the 100-day simple moving average, the high close in April, those are all going to be big levels to break going forward. But right now, you can see where it's been really, the action's been really up and down. It's been, the S&P 500 has been getting a run, pulling back, getting a run, pulling back, and now it's getting to a point where, you're getting, it's down one day, up the next, down the next day. Look at all the black candles, where it, it opens and then closes below the open, even though it's up on the day. Just a lot of wicks on the candles, just really choppy action. If you look here between September, October, November, December, how smooth all the action was, it was just all in a straight line. And now you've got this crazy back and forth, shaking everybody out, lots of indecision, really, it makes it tough to get committed to either direction, because you can easily get shook out if you're a short-term trader. Okay, so yeah, 2017 was a cakewalk compared to the action that's going on right now. And so if you look at SPXL, this is the S&P 500 bull 3 times. You can see here it's down here trying to hold this 200-day simple moving average. It closed below that level today. That's been the big support level. Okay, if that does break, you could see a drop down here. If it turns into resistance, fails to get back above that level, you could see a drop down to 38, down to this 300-day simple moving average. That's been the level that it's bounced off of on the prior pullbacks. The 200-day simple moving average has been a huge support level. Look at all the candles. I mean, look at all the action has been so choppy, so wavy. No real clear direction. Right now, it's in a it's just basically there's the 2 key levels. It's the red line here, the 200-day simple moving average, and the green line, the 50-day simple moving average. One of the 2 levels is going to break. If it breaks above that 50-day simple moving average and stays above, unlike it did here in April, then that would be a signal, okay, the markets are trying to reverse. You could see each time that it's gotten above this 50-day simple moving average, it pulls back. So that has been the sell zone. The algorithms are set to sell at that level. And the same thing has been the 200-day simple moving average has been the support zone. If you could see over here, the moving averages were really far apart, but notice how they're getting closer. Everybody's been talking about it. If this 50-day simple moving average, the green line, crosses the 200-day simple moving average to the downside, the red line, that's what they call the death cross. It's the opposite of the golden cross, and it would signal more major downside risk for the markets. You can see the same thing here with the S&P 500. You've got the green line coming down as the red line's coming up. If you look at the IWM, it's got a better pattern going. You can see that they're both more pointed upward, and so that's why the Russell 2000 and the small caps have been better. It has been stronger. If we look now at the Dow Jones Industrial Average, let's see here. Did I show you? No, I did not show the SPXS. If you look here, XPSS, this is the S&P 500 bear 3 times, and so you can see it's back above the middle Bollinger Band, and so it's, sorry about the jumpy screen here, it's been bouncing off of the 50-day simple moving average and 100-day simple moving averages, and you can see here where the green line is pinched with the gold line. You have the 50-day simple moving average at 28.27 and the 100-day simple moving average at 28.26. And so this is setting up for a bullish crossover. You know, if the green line crosses the gold line to the upside, this is a signal that this chart is actually building strength. And so, you know, and the candle closed back above the middle Bollinger Band. You can see all these candles are trying to turn that dotted purple line into support. If 28.63 holds, that is going to signal more upside potential. You have this 3150 level is going to be the big level, and then up here at the 200-day simple moving average at 3226. So keep an eye on it. Going forward, above 2950 is going to signal more upside potential, and if it drops below 28, that's going to signal downside risk. You could see that lower Bollinger Band tested again, like it did back here. You know, once again, you know, you could see where the action has been extremely choppy, up and down, up and down. I mean, look at the candles here. You know, red one day, white the next. You know, the action has been like that consistently, and so it's been hard to get sustained runs for the bulls and for the bears. Okay, if you look at the Dow Jones Industrial Average, you can see here it's hitting very oversold levels again on Fasto. It's down at 11, and this is typically a bounce level. You know, you can see you know, down here when it gets down to this level, at least it gets a technical bounce. You know, each of these two spikes down here were followed by white candles, and then once again you have a spike right here, and then, you know, that was followed by, you know, white candles. And so now you have Fasto back below 20. You know, this is signaling that it's oversold and due for a bounce. You've got 4 red candles in a row. You know, the big level to bounce off of is going to be the 200-day simple moving average at 23.739. That level has been holding. You can see it bounced right off of that level at the beginning of April. If there is a break below that level and there is a close below, that's going to be the major red flag. You know, that's when you could see the Dow really breaking down and testing that. You know, it could possibly pull all the way back down to that 300-day simple moving average. You never know. The bottom line is the 200-day simple moving average is rising. The candles are coming down, and it's coming to this flex point where, you know, this level is going to be tested very strongly, and it's either going to hold or it's going to break. If it breaks, you know, you're going to see it drop down to this low close in March. You know, and if that were to break, you know, that would signal major downside risk for the markets. Now to the upside, if you do get a bounce here and the Dow Jones Industrial Average gets moving to the upside, what it needs to do is get back above that middle Bollinger Band at 24.323, and then back up here above that 50 and 100 day simple moving averages. And so basically, though, the first thing that needs to happen is above that EMA4 at 24.078. Okay, if you look at XLI, this is the industrial select sector spider, and so yeah, this is following the industrials, and you can see here it's pulled back now for 5 days in a row. So you have these multiple red candles in a row. It broke below that 200-day simple moving average on Monday, and so yeah, it's 5 days down and rebound. It is a good trade. You know, many times, you know, once you get that many days down in a row, it sets you up for a technical bounce. You could see it's hitting the February low. This is the low level for February. So you're looking at, you know, this was the lowest close of 2018 for the XLI. And now you're pushing you know, this is testing now the level where it broke out back here in November, and so when it got back above that 50-day simple moving average, and so basically if it drops down any lower and it hits this 300-day simple moving average at 70.22, it should get a technical bounce off that level. Look at the long upper wick on today's candle. I mean, they ran this thing up and then pulled it all the way down, forming this long upper wick. So a lot of people, you know, got trapped in this, trying to play the bounce, thinking that it was ready to go, and then that last hour of trading today really, you know, pulled the rug out from underneath everyone. And so what you want to keep an eye on is EMA4 at 72. Trading above 72 would be a signal that the bounce play is happening. But keep in mind, it's all about the close. It has to close above EMA4 to try to get the bounce going. Fail to do that, and that'll signal more downside risk. I mean, look at all the crazy action here. I mean, look how this is just up and down, up and down. Yeah, you know, so right now this has been on a sustained downtrend, and so we're keeping an eye out for a technical bounce. Okay, let's look at power shares, QQQ. So yeah, this is the you know, a look at the Nasdaq stocks, and the bottom line is it has that choppy action as well. I mean, look at this black candle. You know, that was brutal. You know, they gapped it open and then drove it down. You know, wiping out all the premium, even though it was up on the day. For all the call options got wiped out, and then they had the red candle, and then you've got the white candle bounce trying to get it going again. For people that have Friday weekly expiration, and then today, boom, red candle wiped out all those calls. You know, people were dumping them heavy, and you know, a lot of the premium got wiped out for those Friday expirations. That's what's been happening. You know, the market makers have been ruthless, and you know, that they have it's been you know, pretty brutal here. Look at the action with the red candles. Look at the black candles. Look at the you know, how you have yeah, you know, just this back and forth action, and so you know, there's going to be either a break above resistance or a drop below support. Right now, it's just holding tight onto that middle Bollinger Band. It closed right at that level again. It's all about 161.50. You know, if it drops below that level, that's going to signal downside risk. You know, that a drop below 160 would be a major red flag. It has to stay above that middle Bollinger Band, and then it needs to break above the 50-day simple moving average at 164.10. If it can get above that level and turn into support, then it could get moving. Back here in April, it got above that level and it failed to hold and it pulled back. So yeah, so it's yeah, been really tough this last few days with this back and forth action, and you know, the charts wound tight here, and so there's either going to be a break above resistance signaling upside potential, or there's going to be a drop below support signaling downside risk. You know, one of those two levels is going to break very soon, and so yeah, it was a really bad close today, and so we'll see how tomorrow follows through. You know, if it follows through more to the downside, or who knows, there could be a big bounce, or yeah, it's just tough right now. So let's look at TQQQ, and so this is the Ultra Pro Triple Q, and so you can see here it has that same type of pattern. You know, where it's in this sideways action. You know, it's heading sideways. You know, it's trying to make up its mind which way it's going to go. It's all about breaking that 50 and 100-day simple moving averages and turning them into support above 155.57. You know, if it can get above those levels, that's going to signal it wants to head higher. It has to break above this high close level on the 18th. Now, if that middle Bollinger Band fails to hold, you're going to see that 200-day simple moving average tested again. That level needs to hold. You know, it's all about holding that level, because if that broke, then you could see a drop all the way down to 123. Now, you know, it's all about holding the 200. You know, that's been the load level, and then the 50 and 100 have been the sell level, and then eventually one of those two levels is going to finally break, and then we're going to see a market direction, likely, you know, maybe for a more extended period of time, when one of those levels, you know, either turn into resistance or support. You know, because right now you've got a lot of sideways action going on. You know, it's back and forth, and so it just seems like the direction is not real clear right now on which way the market wants to head. Okay, if you look at XLE, you can see here that the energy has been the bright spot. You know, this has had the more sustained run. This has a much better chart than anything else we've been looking at. If you look down here, check out this February to March action. So you could see this is kind of like what the other charts we've just been looking at, this back and forth. This has more of a defined sideways channel, but you kind of get that where you've got the red and white, and it's going back and forth, and it's all indecisive. You know, that's what these charts are saying right now. You know, they have this kind of look with XLE, not quite as defined, but they have that kind of back and forth indecision. And so you could see here when the XLE finally broke out on this candle above the 50-day simple moving average and 100-day simple moving averages, it got a nice sustained uptrend going. And so this has a clear uptrend on the daily chart. This is a much better looking chart than a lot of the other charts that we looked at. Now it needs to bust above this 75 resistance zone. If it can get above this high close here, that's going to be a signal that wants to head higher. Keep an eye on EMA 13 and that 73 level. If it drops below 73, the middle Bollinger Band at 72 will be on deck. As long as that middle Bollinger Band's holding, this uptrend's intact. Now this has had that choppiness sideways, but it's during this nice uptrend, as opposed to, you know, when you look at the other charts, you know, they have more of a symmetrical triangle pattern type of thing going on, where there's not a clear uptrend or downtrend. It's more you know, it's not as clear of the direction. You know, it's indecisive right now. It doesn't know which direction they want to go. But you can see XLE is in a strong uptrend. You know, it is cruising higher. Now, if it were to break below 72, that would be a major red flag. And why I say that is, if you look over here in January, you know, it had the same type of pattern. It had the uptrend, and then it finally broke down below that middle Bollinger Band, and that's when the downtrend started. And, you know, that was the whole signal to get out. And that'll be the same signal again. If you look at XLF, this is this financial select spider, and so this is following the banks. And so, as you can see here, everybody's been, you know, is loving the banks, but they are not performing. You know, for it seems like, you know, all these top analysts keep saying, you know, JP Morgan, Goldman Sachs, you know, buy, you know, now it's, you know, buy MasterCard. By Visa, that was today's theme. You know, it's which their charts do look better, but as far as than the banks right now. But if you look at XLF here, you know, this is not performing well. I mean, if you look at XLE, you know, this is a nice uptrend. This is what all those bank bulls want. You know, they want this XLE chart. You know, this right here is signaling downside risk. It's below the middle Bollinger Band. It dropped below 27.59. The bears are winning right now. And so now it's headed for the 200-day simple moving average at 26.87. It looks like that level is going to be tested. And so if that level were to break, that would be a major red flag. Now look at this red flag. So look how bearish the banks are. Look at the crossover. Check out how the 50-day simple moving average, the green line, crossed the gold line, the 100-day simple moving average to the downside. So that's really signaling that the chart is losing strength and breaking down. So that is not good. And notice how this horizontal support that is lined up with the 200-day simple moving average. That's going to be the crucial level. If that level were to break, then the banks would be in big time trouble. Notice how they're able to drive this down on lighter volume. So that has been one theme, is that the volume has, you know, we haven't seen giant volume. Look at the big volume down here when it bounced, and the big volume here before it broke out higher. You know, people have not committed to saying that you know, through the volume bars, we aren't seeing commitment down here that this is the bottom. You know, you would think that once it hits a zone and you see a big volume spike up here, you know, like you get volume up in this range, similar to these other large volume bars, you know, up here in this 140, you know, at least up in this 100 million range. That's where you'd be thinking that okay, people are really psyched on the banks again, and then maybe it could get a rally going, because that's what happens is they load at the bottom. And so right now you're not seeing people betting big on this pullback. And so look for a big volume spike and a bounce off of support as the signal that okay, this is finally the bottom, and now it's really ready to reverse. Okay, thanks for viewing this video. Come check out the chat. I'll post the link below the YouTube video. Thank you.